In this video, I'm going to highlight supercharging your Roth IRA via a backdoor contribution. I'll begin the video by comparing the Roth versus traditional IRA, then talking about how the backdoor Roth IRA works, what are some key points to remember for proper implementation, and then wrap up with who it tends to be for and who it may not be appropriate for. So let's begin by reviewing what is a Roth and what is a traditional IRA. Well, a Roth IRA is a retirement account, and the contributions you make to it are done on an after-tax basis. So you're contributing to it with after-tax dollars. What that means is you're not getting a tax benefit or a tax deduction on the front end. You're contributing after tax, but in exchange for that, you get to receive tax-free withdrawals. So you put money in, you don't get a tax benefit, but the IRS says we didn't give you a benefit up front, so we're going to give you a benefit on the back end in the form of tax-free withdrawals. Now, with the Roth IRA, your contributions, your basis, the money that you put into it originally, you can access that at any time, tax and penalty free. It's the earnings on those contributions that you have to wait 5 years and be over the age of 59 and a half to receive tax free as well. Now, in comparison, a traditional IRA tends to be pre-tax contributions. So the money you put into it lowers your taxes in the form of a deduction. And because the IRS gave you that tax deduction up front, they're going to tax you on the back end in the form of withdrawals. Now, with the traditional IRA, most people can contribute to it on a deductible format, right? So the money they put into it gives them a tax deduction. But there's also another type of traditional IRA contribution. There's a non-deductible traditional IRA contribution. There's only two circumstances that I can see where you would contribute non-deductible. The first would be if you had an employer-provided retirement account and your income was over a certain limit and you also tried to contribute to the traditional IRA, it could be considered non-deductible. And then the second reason would be for the backdoor Roth contribution. But a non-deductible traditional IRA contribution, as the name implies, you're not receiving a tax deduction for it. But since it's non-deductible, it would be considered or treated as Roth money or after-tax money. Now, how does the backdoor Roth contribution work? Well, it's essentially two steps, right? So the first step is you have a traditional IRA open that has zero balance, and you make a contribution to it as a non-deductible contribution. So when it comes to reporting that contribution on your tax return, it's pivotal to make sure it's labeled as a non-deductible IRA contribution. And because it was considered a non-deductible contribution, it's after-tax dollars, and it's similar to it as if you were contributing to a Roth IRA, but it's just going into the traditional IRA. Once the money has settled into the traditional IRA as non-deductible, then you want to immediately convert it to the Roth IRA in the form of a Roth conversion. Why I say immediately is the principal, the money that you put into the non-deductible can be converted tax-free, but the earnings on those contributions are subject to tax. So converting the money as soon as possible from the traditional IRA to the Roth IRA will give you the best chance of not owing major taxes come filing of your return. So that's essentially the two-step process for the backdoor Roth. Contribute to the traditional IRA non-deductible and then convert it to the Roth as soon as possible. And again, because this is a non-deductible IRA contribution, it escapes the taxation as opposed to if it was a deductible IRA contribution. So some key points to remember for effective implementation is the conversion to the Roth IRA needs to happen before the end of the calendar year. So if you were to put this money into the traditional IRA, you need to convert it to the Roth before December 31st of that calendar year. There's also a stipulation to where the balance of the IRA or any IRA you have needs to be zero. And this is based on the IRS pro rata rule, which combines all variations of individual retirement accounts. So in order to escape taxation on a backdoor Roth contribution, you need to have all your IRA balances zeroed out by the end of the year. And then the third leg of the stool would be you need to complete Form 8606 on your tax return to report the backdoor Roth contribution. So to give you an example of how this works is a contribution to a retirement account, Roth IRA or traditional IRA in 2025 is $7,000 if you're under the age of 50 and $8,000 if you're age 50 or older, because you get that additional $1,000 catch up. So how this would work is you would contribute $7,000 if I'm under the age of 50 to a traditional IRA, max that out right there. And then once that $7,000 is settled in the traditional IRA, I move it immediately to the Roth IRA. And then on my 2025 tax return, I'm going to report the non-deductible contribution of $7,000 and then the conversion to the Roth IRA of $7,000. And if I do that as soon as possible, once the money is settled, then hopefully there's not going to be much earnings on that $7,000. So now that we've kind of gone through that example, let's talk about who's it for and who's it not for. So it tends to potentially make sense for those that can't contribute to the Roth conventionally. What's important with Roth IRAs is if you make over a certain amount of money, then you can't contribute to it, right? So backdoor Roth IRAs tend to be for those people that make so much money where they can't contribute conventionally to a Roth IRA. They're over those income limits, right? So that's one point. The second would be if they're already maxing out their employer provided retirement accounts, right? So if you're already maxing out your 401k through work, maybe you've contributed some Roth money to that, you have additional cash and savings that you want to put forth towards your retirement, then you could look at a backdoor Roth IRA contribution. Also, you have no IRA balances, right? So if you have individual retirement account balances, whether it's a traditional IRA, a SEP IRA, a simple IRA, any variation of an IRA, you have that money in there before the end of the year and you try to do a backdoor Roth, then the IRS is going to tax part of that, right, based on the pro rata rule. So it makes sense for those that have all their pre-tax money shoveled into their employer provided retirement account, like their 401k, and don't have any balances in any types of IRAs. And then finally, could understand how to properly implement this on the tax return and converting it as soon as possible once it's settled in the traditional IRA. Then who's it not for? So it's not for people that their income is low enough where they can contribute conventionally to the Roth IRA, right? You don't want to have to jump through all these hoops to do the backdoor Roth if you can just make a standard $7,000 Roth IRA contribution, right? Your income is under those thresholds. Second, if you haven't maxed out your employer provided retirement account, your 401k through work, then you might want to look to do that first because the contribution limits for that are going to be higher than what you can put into the Roth, and you can contribute to the Roth 401k. Third would be if you have IRA balances, right? So if you have large IRA balances and it doesn't make sense to move them to a 401k, or you can't do that based on your situation, then maybe a backdoor Roth doesn't make sense for you based on that pro rata rule. And then finally, if you don't understand the nuances of how to implement this properly. So that's kind of a summary of the backdoor Roth IRA in a nutshell. Click the top right of this video for a more detailed article on this topic. And thank you very much, and hopefully it was helpful.